get, we couldn't even figure out their revenues and couldn't figure out their payroll. And it was hard to even report their payroll because they were not keeping track of all of those things. And the government, in fact, even there was one company we applied for that we went back and forth with their bank and still couldn't get it because they didn't have a good recording system. The EIDL, on the other hand, has nothing to do with payroll, but every business within the United States, all of it's been in existence for a long time. It's called the Economic Injury Disaster Loan. It's been in existence for a very long time. There's very, very minimal requirement, and a lot of businesses can qualify because of Corona, because Corona is considered a disaster. But most businesses couldn't even have access to that because they hadn't really taken time to even build a simple income statement. I think the only requirement of the EIDL was the income statement and your taxes. And most businesses, a lot of people did not have a well-structured accounting system, so they couldn't even apply for that. Now, for those who were able to apply, we were able to get up to 150,000, 200,000 for very small businesses that had one owner, or some of them have two, the owner plus one employee. They were able to get about $150,000. For 30 years, they paid nothing for the first year. No, it had no, you didn't need any security. You didn't need to go through a rigorous approval process. It was really a 2 weeks process. You get approved. The money was in the accounts the next day when they got approved. And the process was really very, very quick. But we were able to apply because of the ability to have a good accounting system in place that we can use to give the numbers that the government required for. So my biggest thing is, if you don't know anything, for having a good accounting system not only help you qualify for loans and grants that the government gives out, or even that the bank can offer, it helps you also stay legal, because the IRS will come after you if they begin to see that things are not working right in your company. The laws of this company do work, and that's one thing I figured out about America. The laws do work. And sometimes until it gets you, you don't really see the importance of it, but it doesn't take much to stay, legal within your small business. And that's what I want to show you today. So you can have a good understanding of what to do to be able to keep your books. So bookkeeping is simply, recording transactions as you pay, like as you pay your bill, as you get money in, basically recording that transaction. I say accounting tells the story of your business in numbers, okay? So whatever happens in your business is about money. Money is the underlying factor of your business. If your business don't make money, you are not in business. Even if you're non-profit, remember, it takes money to do everything that you do. So basically what bookkeeping does is it's a way to track your business, tell the story of a business in finance, in money. And there are some components that are essential to having a good bookkeeping system. So when you think about a typical accounting report for a normal business, there's three major areas. There's the income statement, there's the balance sheet, and there's the cash flow statement. That is, if you have thinking about a financial statement for a company, okay? These are the three things that accountants will focus on. The income statement shows you how much money you made through the year. The balance sheet tells you what is the worth of your company. The balance sheet is made up of three parts. The assets are all the things that your company owns. The liabilities are all the debt your company has. And then equity is what you have put into your company. Your asset is always equal to your liability plus your equity. I'm not going to go into balance sheet today, because that is something that if you want, you would need an accountant to really help you do it right. The same thing with the cash flow. I think the bankers talked about cash flow statement yesterday. That is basically the tracking of all the cash going in and coming out of your business. Okay, all the cash going in and coming out of your business. Same thing, I'm not going to go deep into cash flow today, because to have a really good cash flow system, you likely need an accountant to build that for you. Today, I want to focus on income statement, because the income statement is the most required and the most used part of all these statements. And as a small business, even before you get to a place where you may need an accountant or not, your income statement is the most important piece that you have to have. It's what will tell the story of your business through the year. And if you're a small business that you're not doing a lot of volume, you use a simple Schedule C to file your taxes, then the income statement is what you need to file your Schedule C. So that having just the income statement kind of gives you a lot of, at least it helps you stay legal. And that's what we focus on today. If your business is moving really fast and you need these other statements, then you need to reach out to an accountant. As we go through, please don't forget to type in your questions, and then I'll make sure I go through this quick so that at the end of the presentation, there will be room for questions. But on the income statement, there are 3 things that you need to know on your income statement, okay? You need to know your revenues or sales. That's the money you get when you provide a service or when you sell a product. That is the money you get when you provide a service or when you sell a product. That's your revenue. And then you have expenses. That is all the things that you spend money on in order to provide that service or to sell that product. And then the difference between those two gives you your profit or loss. So you see in the slide, I have a small picture. I captured a very simple income statement. And then there it tells your sales. And then from your sales, which is the revenue, it moves to operating expenses, then your operating income. There's a lot more. You can see there's sections to it, but we'll get into some of those sections as we move forward. So basically the income statement examines the revenue expenses to determine the net profit over the period. Most income statement is over a period of 1 year, okay? So now let's get into revenues. Now let's dig a little deeper. So as I said, revenues is the money that a business receives when it provides the services or it sells a product. There are 2 types of ways you can keep track of your revenues and even sometimes your expenses. One of them is cash accounting. The other is accrual. I'll just explain the difference really quick. We will focus on cash. If you're a small business, if you're a small business that you are not doing a lot of activities, maybe you're a one-man business, just focus on cash accounting. Don't even worry about accrual. If you need to use accrual accounting, you need an accountant. But let me explain the difference. When you say accrual accounting, all that it means is that in your keeping of your records, you have receivable. That means that you let's say you provide a service. Let's say you sell a phone, you sell phones for your business. When you sell the phone and you don't receive the money immediately, in accrual accounting, you can still recognize the revenue. The phone is $100. You've sold it, but the person didn't pay you. They will pay you next week. In accrual accounting, you can still write that you've received $100, even you've earned $100, even though you've not received the cash. You can say you've earned $100, even though you've not received the cash. In cash accounting, you cannot say you've earned 100 until the cash comes in. So when you do cash accounting, all you are doing is when you get the money, you write it down. When you haven't received the money, you don't record anything. And the reason why, as a small business, you want to do cash accounting is accrual accounting has a lot of technicalities, and we cannot get into that. Remember, we are only focusing on simple things that can help you really keep track of your business so that you can use it for tax purposes, and you can also kind of work with it yourself until it grows to an extent where you need a help of an accountant. But with cash accounting, it's very simple. When you make the money, when the cash comes in, you record it, okay? So basically that is cash accounting. So there's two kinds of revenue when you are doing a business. There's two ways you make money. You have your operating revenue. What that is your operating revenue is the money you make when you are doing the key services of your business. And then the non-operating revenue, which is the second part, is the money you make on the side. Let me give you an example. If you have a business that you sell phones, whenever you sell a phone, it's your operating revenue. So that becomes your normal operating revenue. But when you maybe have an investment as part of your business, you have an investment, or you get your savings account, your business savings account makes interest, that interest is still revenue, but you cannot record that as operating. You have to separate those two for management purposes, because you cannot use the non-operating revenue to make management decisions, because you can fail. And one of the best uses of accounting is to help you make good management decisions and plan for the future. So you need to separate your operating revenue from your non-operating revenue so you can make good management decisions moving forward. For IRS purposes, sometimes the non-operating revenues, some of them have different tax treatment. So if you don't separate the two, then the way the IRS treats it, it can get you into trouble at the end of the year when you file taxes. So even for tax purposes and for management purposes, you need to make sure that you have those two. You separate your operating revenue from your non-operating revenue. Okay, so hopefully that gives you an idea of how to record revenue. So basically all you have to do is decide what kind of business you are in. If you're in a service or you are in a sale of product, you know that, okay, whenever I sell a product, that is revenue. And that is one, you can record that. At the end of this presentation, my goal is for all those who are doing their own business and kind of want some help with their keeping revenue and keeping a simple income statement, I will provide a template that will kind of classify revenue, expenses, and everything. But I'm just explaining to you here so that when you get that template, you can understand. But if you want that template, you would have to email me so that I can give you that template. So I can give you that template. Expenses. With expenses, what you need to really understand is that there's always the fixed and there's always the variable. The name explains itself. When you have a fixed expenses, it's the expenses that you can do much about, okay? The expenses that you always will have to go through and like, for example, rent. As a business, you cannot really get around your rent. I saw that somebody here had a business that does coaching on the side. If you think about coaching, your fixed expenses will probably be, think about some of the softwares that you use. If you pay monthly for your website, mostly the administrative expenses are your key fixed expenses, because most of the administrative expenses are, number one, they are constant, but also whether you speak 500 times within the year or you speak 10 times, those administrative expenses will always remain the same. And that's why we call them fixed. If you, whenever the expenses grows as your business grow, then that expense is a variable expense. Think about this. So as your business grows, most of the time, the fixed expenses will stay the same as your revenue grows. If that particular expense increases as your revenue increases and goes down as your revenue goes down, then that is variable. So if you are a barber, if you're a barber, and then let's say that you use hairspray for everybody that comes to cut their hair. If you do 100 clients a month, you will probably use more hairspray than if you do 20 clients. And so that hairspray becomes a variable expense. So whenever you buy it, the more hair you cut, the more hairspray you have to buy. But the rent you pay on the property, the electricity and all of that, sometimes electricity can be funny, but the rent and all of that stays the same. You can have 1,000 people come through your door. You don't have to pay more in rent. So the rent becomes your fixed expense, and then your variable expense becomes those other materials that grow with your revenues. The reason why you need to keep those two things separate is for budgeting purposes. When you budget or when you plan in your business for budgeting purposes, if you don't understand that your fixed expense will always stay the same, you can run into trouble when you budget for your business. And if you are here on this platform and you have a business, you know you have to understand, you need a budget. You need to plan, because budgeting is basically planning your expenses and your revenue for the year so that you can continuously monitor your progress as a business to see whether you are doing well with accordance to your budget, or you would also understand if your business is doing well, why you are losing money. So for budgeting purposes, you need to also separate your fixed expense from your variable expense. Your fixed cost will always stay the same. So you know that, okay, if I have a fixed cost as a business of, let's say 10,000, then you understand that whatever you do as a business, you need to make way more than 10,000. If your variable cost goes with the business, then now your variable cost, you don't even care about the dollar value, the dollar amount. What you care about is the percentage of that cost to the revenue. What do I mean by that? Because the variable moves with the revenue, because as your variable cost grows, your revenue grows, you want to make sure that the percentage of a variable cost is always low compared to the revenue. So for every $10 you take for cutting hair, you want to make sure that maybe 10% of that is what goes to hairspray, because that 10% will help you manage the amount of hairspray you use. So anytime the cost of hairspray is getting to about 15% of the revenue, you know that you are not doing something right. Okay, what I'm trying to teach here is I'm trying to help you understand how to use accounting to make good management decisions and to help you plan your business very well. If you are a speaker and then you go out to speak, one of your key variable costs is going to be gas, or is your one, yeah. So you think about gas, or you think about even what else would you need as a speaker that, you know, maybe marketing. As the more you advertise, the more your so your marketing expense really goes hand in hand with your speaking. A lot of times what I see a lot of coaches where they miss out is when their marketing expense begins to overtake the revenue coming in, and because they don't plan it as a ratio to in revenue, they end up losing more money than they are making. So if you do anything, especially with services, what you have to understand is you need to begin to plan your expenses as a ratio of the revenue, so that you don't end up spending more money promoting the product than you are getting from that product. And that is how a lot of businesses go bankrupt. That is how you begin to lose money. The tracking of your expenses is probably one of the most important aspects of your business, because that is also where you save your tax dollars. Just as a general knowledge, every legitimate expense you have in your business, you can write it off tax-wise. Okay, I'm gonna explain it. So if you make $100,000 at the end of the year on your Schedule C, if you make $100,000 and then you spend $80,000 in marketing, transportation, you know, commission, mileage, office supplies, whatever, the government will not charge you taxes on the $100,000. The government will only charge you taxes on $20,000. But if you don't have a good tracking of those expenses, now you are stuck with a tax burden of $100,000 because you didn't keep good track of your expenses. So it's really important that you understand how you track your expenses. Now, the expenses, the reason why you also need to split them up and understand how they affect your business is some expenses are treated differently by the government than others. For example, you are allowed to take some part of entertainment expense on your taxes. It changes year to year. I know last year, for example, if you went out with for your business, you know, coaches and some marketing and even professional services, even myself as an accountant, I may go out with a client to eat. And it used to be that you can take 50% of that because you are eating, but it's a business lunch and you will be able to take 50% of that. You know, they changed the tax law that sometimes you can't even take that. You know, it depends on who is president or whatever the IRS issues. But those things change. And if you don't have a system to know which money went into food and which money went into actually maybe the mileage, then you are stuck with, you know, having to eat all of that as profit, but maybe you legitimately have a way to expense those. The IRS gives you, I think now it's about 57 or 54 cents per mile. So based on your travel as a business, you have to know that you have to know how the mileage system is tracked. All of these things, there's a lot of tools, or even the sheet that I'm going to send you, you can keep track of all of those things. Sometimes in a business, especially most of us that have one-man run businesses, sometimes in your business, you may have more expenses that you can report than even the income. And because you are a Schedule C, that loss can go against your it can go against your paycheck or your income you make on your normal job. And let me explain that a little bit more detail. If I run this business, I have partners. So now I don't run it just by myself. But let's say I run this business by myself, and then I ended up spending 30,000 this year on the business, but I only made 15,000. And then in my normal job, I got, let's say, $70,000. When I go to report, and at the end of the year, I file taxes, let's say if I report $70,000, I will end up paying taxes of $3,000. But now, because I lost $15,000 in my business, I can take that $15,000 that I lost in my business and then use it to reduce my income of $70,000. So now I don't have to report $70,000 as an income. I only have to report 55,000. So now I only have to pay taxes on 55,000. And sometimes that can shift you from a tax bracket. So you realize that instead of me having to pay the government, now the government is going to give me a refund because I have reported lesser income and they take it against my business. That is possible. That is one of the most powerful benefits of running a business, because if you understand how your expenses work with your income, you will be able to do a lot of legal things that will allow you to maximize your tax benefit or reduce your tax burden. And you can only do that legitimately if you understand how the income works with your income works with your expenses. So this part is really important to me, keeping good track of your expenses, receipts, being able to have you write the things down. It's easy to keep a log, and then keeping a receipt of all your expenses to make sure that your business expenses is not mixed with your personal expenses. The number one rule of running a small business, no matter how small your business is, your business expenses should not be mixed with your personal expenses. And that is where a lot of people get caught, because the moment that happens and you get into an IRS audit, you are in trouble. So you have to have a system of separating those two, really important. And even as we talked about yesterday, you need a business bank account. Do not use your personal bank account to run your business. Have a business. It doesn't take a lot of money. And we went through a lot of the details, the requirements and everything yesterday. You need a business bank. Let me show you one of the easiest way to track your expenses and your revenue is when you have your business bank, let all your business expenses run through the business bank. So at the end of the year, your bank statement can be your income statement. And that is one of the simplest solutions I even tell people. As long as you can trace all your expenses and revenue through your bank, you can use your bank records to really also fill out your income statement and use it to fill out the Schedule C and file it with the IRS. And if you run into any audit, all you have to do is show them the bank statement and the government can track and see all your expenses. So even if you lose a receipt, you can track that expense through your bank statement. So having a bank statement is really important. Don't ever underestimate that, having a business bank statement. So I know I spend a lot of time in expenses because as an accountant, that is the number one place I see problems with businesses. There's so many caveats with it, but your expenses, your business expenses needs to be tracked really, really well. And that you don't want to mix that with and I will be happy to answer questions on expenses, tracking them and all of that. And also the sheet that I provide. Actually, when I provide you that sheet, it will look something like we will have some different classification of expenses. So you can see there can be advertising, banking fees, commission, consulting fees, contract labor, mileage, office supplies, postage and delivery. So you may not use some of these, but you may be able to apply some of these. And then you can classify them as you see fit, okay? You can classify them as you see fit so that you will be able to really track it with that Excel sheet. And we could do it by month. There are various ways you can do it, but these are just common ones I see with most businesses. If you sell products, let me go back a few slides, let me show you something. If you sell products, one of the things I want you to understand is the cost of goods sold. If you look at the sales, it's 100,000, there's a cost of goods sold. That is always separate from even all that expenses. This is how you are required to do it in accounting, because now your gross profit is what you use to actually do your accounting, okay? So what is the cost of goods sold? Basically, if I'm going to sell you a phone and I bought the phone for $30 and then I sell the phone for $50, my gross profit is the 20. Is that 20 that I use to do we call it a gross profit. That's what you use to do all and we keep that as part of the revenue, because then your revenue actually is not the 50. Your revenue actually is the 20. It's your net sale. So your net sales is that $20. So when you do product, it's a slightly different. Your net sales is what you use actually for your Schedule C, okay? So on the Schedule C, you will see sales / net sales. That's what you put there. You don't put all the 50, you put 20, because that cost of goods sold is treated very differently in accounting. If you need more information on that or need help on that, I can help you and then, do that. So basically that is for expenses and that is for revenue. So your income statement typically has these items on there, like the one I showed you. You have your sales, you have your cost of goods sold, and then you have your gross profit or your net sales, okay? Then you have all the other expenses that come into play. Depreciation, a lot of times if you have assets, they depreciate. If you are going to do any kind of depreciation, you definitely need an accountant's help, because it is very technical to calculate depreciation. But it's one of the items that can help you save on taxes, because the depreciation is not money going out of your company, but it's an allowable expense on your taxes. So if you have a depreciation of, let's say, $1,000, you can legally reduce your income by 1,000 with depreciation, but you have to calculate it right according to the law. And that you would need the help of an accountant. So basically, these are some of the key items. What I did on the next slide, and remember, this is going to go out to you. I explained each line, and so that you can use these slides as references. So each line, the 12 lines that I just showed you, I have explained it in detail on this slide. And then you can use that when you request and I send you the Excel sheet, you can use this as a reference point to really do your own accounting, as a business. As your business grow, I highly recommend that you hire an accountant. If you are at a place where it's hard to keep track of all your income statement on an Excel sheet, but you don't have the resources to really hire an accountant, one of the things you can do is look into some of these good accounting softwares, and I put a few there. So QuickBooks is a very popular one. A lot of businesses use it. It starts at $8 a month, depending on, these softwares have made it user-friendly that even as a non-accountant, you have the ability to do some of the functionalities without struggle, okay? So QuickBooks, Xerox, Real-Time XAM, whatever the name is, Zoho Books, FreshBooks. I led my team, we did a research, look at the top 5 ones, and so you can research any of these and call them, talk to them. Some of them have discounts they can give you that you can use as a small business for your accounting. So basically, that is a very short but a slightly detailed synopsis of what an income statement is and how your revenue and expenses gives you the gross profit. A little bit about what Globadime, and then we can jump into questions. So we've been, at my team, Globadime Consult, we have a combined experience of about 20 years in audit, accounting, and all financial related matters. We have clients across the states, within the US almost. And so the services we offer, we do accounting and bookkeeping, we help with taxes. So one of our major areas is tax filing. We do financial planning and strategy, and then we also do business advisory services. What we do, one of the best things we do that most businesses don't do, is we don't only give you the financial report, we also help you identify key ratios that can help you make good management decisions so that your business can grow. As I said, we have a free Excel income statement template for you if you do need that you can use to track your income, your expenses and revenue as your business grows and as your business move forward. With that being said, I'll open it up for questions. And I know Barbara Littles is helping work it out. So
yes, Kwame, I think one of the questions actually had been answered when you provided the information on the software. The other question had to do with what are the pros and cons of building your business with your own money, your personal money, and is that considered revenue?
Okay, so that's a really great question. So if you remember, let me go back. And then this goes into the balance sheet part. I talked to you about the 3 different statements, and then the income statement is what we went detailed. The balance sheet has the asset, liabilities, and equity. When you put your own money into your business, that is actually considered equity. So this is how it's explained. Let's say your business is, you're a taxi driver, so you have a car, right? The car is your asset. If the car is worth $10,000, that is your asset. That $10,000 should be equal to the $7,000 that you owe on the car and the $3,000 down payment you put. So now your equity is that $3,000 that you put of your own money, and then you raise the loan of $7,000, that's your liability. So at all times as a business, your balance sheet, your asset is always equal to the amount of debt you have and an amount of money you put yourself. That amount of money you put yourself is known as equity. So when you invest your own money into your business, it is not revenue, no, it's considered equity. And then that money in the business becomes an asset. So your asset will always be equal to your liability and then your equity. And so your own money is considered as equity in the business. When you do a Schedule C, there is a place on there for the IRS to recognize that. I don't know if that answers the question clearly.
Yeah. Okay, and Kwame, you have another question. With a business account, do I put my profit in my personal account? Is the business account for me to show expenses? Question.
So the way I recommend it, and when I remember when I talked about the PPP and the EIDL, a lot of the individually owned businesses could not qualify. This is important. They could not qualify for the PPP because they did not even consider themselves as employees of their business. The best way to do this is to put yourself as an employee of your business. Your profit is very different from paying yourself. And then so when you have profit in a business, it's after you've taken out all the expenses, which may include your own salary if you pay yourself. At the end of the day, if you take all those expenses, then that will give you your profit. Now you can put yourself on the business as an expense. So you will pay yourself. So you will have a salary. And that is really important because it even helps you to budget. So if you pay yourself $1,000 a month from your business, that becomes a part of your expenses. The profit is very different. Normally in a typical business, the profit, you can even reinvest into the business, or you can take out the profit, which will become, at the end of the day, it's like you are taking some of the equity and then you can keep the profit. But whatever you keep, you pay taxes on. But if you have to separate that profit that you keep from the salary that you take from your business, because those two are really treated differently, even for tax purposes. So let me explain that again. If you have a business, put yourself on there as a salary so you can separate that from the profit. And a lot of times you will realize when you do that, that if you pay yourself in the business, most of people begin to realize that their business is actually running at a loss, because when you consider your income, you realize that you're not making enough money to compensate for the revenue, and it helps you work harder or plan better for your business.
Okay. And then the second part of that question, Kwame, was, is the business account for me to show expenses, or is it for something additional?
For you to show revenue and expenses. The business accounts, like, the bankers went through the advantages, but when you have a business account, so because all your financial transactions runs through the business account, anybody that pays you, you deposit the money. Really important. I had a client, true story. I had a client that was receiving money, and a lot of the money was coming in as cash, and they would never deposit the money because, of course, they didn't want to pay taxes on it. What they didn't realize that what they would do is they were understating their revenue. So in the next year, when he wanted to expand, he went to the bank for a business loan, and then he was telling the bank he can make up to $200,000 a year, but he only shows $50,000 because he keeps the rest of the money. And the bank is like, well, we don't have any evidence to show that you are actually making the money you say you are making, so we can give you the loan. And that creates, a problem. So it's really important that even if you are receiving cash, you deposit everything in the bank so you can track all your revenues through your bank statement. And then every time you spend money, if you have a debit card with your business account or whatever it is, or a business credit card, however you have your expenses, you can use that, and that will show every money you spend. So at the end of the year, your income, when you take your bank statement, it will show all your revenues and it will show all your expenses. And that has to reconcile with your own record keeping, your income statement that you've been keeping by yourself. And you can use that also to file your taxes as the Schedule C.
Great. Kwame, has the government made a decision on a business paying back funds if received PPP and LDIC, EIDL?
The EIDL you have to pay back. You do have to pay back. The beautiful thing about the EIDL is you have 30 years to pay back. So, and then I think the rate is 3.75 constant for everybody. So it's low interest, very little, and then you have 30 years to pay back. So it's not something that they are rushing you. And even when you receive the EIDL, the first year you don't pay anything. You start paying after the first year. So you don't accrue interest and you don't pay anything for the first year. The PPP, there are qualification expenditure items that if you use those money for those things, you don't have to pay it back. And some of that is if you use the money at a certain percentage to pay your employees payroll expenses. And then if you use it, and then remember, you can be an employee of your own company. So payroll expenses, and then I think some sort of mortgage payments and some debts that the business may have. Those have been changing. So it's really important that at the time that you are going to report, you review the IRS has websites that if you reach, I can share with you. If you review, they will have those stated there. So you know which ones qualify and which ones don't. But the PPP can be forgiven if used in the right way.
Great. Kwame, are churches required to submit the 3 financial statements as well, the income, the balance sheet, and the cash flow statement?
Well, so churches, it depends. If a church has payroll, then they have to do payroll. They have to file for their payroll taxes and everything. Churches are not required to submit anything to any governmental agency, with the exception of the people that go to the church. And that is based on even the church's own structures and systems put in place. As a church, if you have a board that really monitors all your expenditure and everything, then you will report to the board all the financial information, or your members, the financial information. If you want to get a loan as a church, or you owe the bank, then the bank can require the church to have certain financial systems in place. And a lot of times they only even use audited statements to do that. But the IRS has no requirement for the church to report unless the church does payroll. That is the thing that IRS requires churches to have. And then there's no fraudulent activity or anything like that going on. But mostly the ones the church is responsible for is the members and the board of directors. And if the church has a loan, then the bank. So those are the most of the time the stakeholders for churches.
Okay. Please break down the acronyms PPP and EIDL.
Oh, PPP is the Paycheck Protection Program, and EIDL is the Economic Injury Disaster Loan. I think I can send you the details later.
Yes.
Yeah.
Those were all the questions. I did have a question, Kwame. Is there a point at which the IRS will consider a business a hobby instead of a business based on a declaration of no income for a period of time?
Well, so the declaration of no income doesn't necessarily mean there's no business activity, right? So let's say if your business has never had an income, but it's been losing money, that is considered business activity, or is in breaking even. Let's say you spend as much as you make, so your income is 0. It's still business activity. As long as your business has activity, you need to report to the IRS whatever activity is going on. If your business has no activity, then that will make sense, But as long as your business has activity, then it needs to be reported to the IRS.
Okay.
With that being said, if your business has 0 activity, then there's nothing to report. But that most, if you have an individual business, that's why you do Schedule C. So that, and even if your business is not registered, let me say this real quick. If your business is not registered, and it's a business, you still can file a Schedule C. And what you do is you then, instead of using the EIN number, which is the employee identification number, you use your social security number. You become the identity of your business on the Schedule C. So even if you don't have a registered business and you have business activities, let's say you cut lawns, but you make the money without really with the registered, you can still report that to the IRS. That tax statement can be used in the future, even if you need a loan or something, because it has been reported, and that is verifiable numbers.
Okay. What if
Yes.
the church only has a few employees on payroll? Would the church still be required? I assume that they mean to report. Is there a threshold of payroll compared to overall church revenue?
No, payroll is payroll. As long as you have payroll and you file the W-2s, you pay tax, you have payroll taxes you need to file, even if you have one. And if you don't file the W-2s and you have a 1099, that is still report that has to be sent in. So regardless, payroll is payroll. So that is what the government requires.
Okay. I have a
Yeah.
question from Patrick. I'm not sure what he's meant. Do you still qualify for assistance if you miss any of these sessions? I'm not sure.
Well, like I said, the PPP and the EIDL still have money available. Really important. This is probably this is one of the most important information for all of you businesses on here. PPP, EIDL still have money available. As long as you have the required documents, you can still apply today and get money.
Okay. I think that's it. And for those of you who were interested in entering into the drawing, you can put your number in, 1 through 100. Number 1 through 100. You pick a number and just post it in chat. Any number between 1 to 100. Thank you. Kwame is excellent. Oh, we put the same number. Okay, at the same time. Kwame, excellent presentation.
Thank you.
Thoroughly enjoyed. Great information. I know that I think Pastor Chris is on the line. Pastor Chris, would you like to have parting words? And I know that you probably also have the number that you've drawn.
I think you're on mute, Pastor.
Yeah, I did. I'm gonna mute him now. He
Okay.
did.
Excellent job. I apologize. I didn't have it, but great information. Thank you. A couple questions answered personally for myself. For those of you who are on, please invite someone else. Tomorrow will be another phenomenal presentation. We're just trying to grow ourselves in the season to be better. Tell people don't miss this information. It's vitally important for us to continue to grow in our businesses and to go to the next level. I honestly believe this is our season. It's time for small business owners, predominantly Black. We want to just help and support. It doesn't matter what race you are in, but we want you to just, or that you are, but we want you to exceed. And so that's the most important thing. Today, on yesterday, we were able to give out masks. We're talking about the safety. Now you'll receive a punch bowl card. I can't see the numbers maybe, but the number that was given was the number 44. So whoever 44 or closest to that, if you exceeded it, if you gave 46 or 45, you're still a winner. If you gave 41, whoever is close, if you can just give me that, we'll proceed from there. And we'll send you your Punch Bowl gift card out to you. 49, I just see someone.
What was the number, Pastor?
The number was 44.
44. Okay,
I see-
49 from Lula Woodard.
There's 247s.
Mm-hmm.
There's 247s. All righty. Who's
Tomiko and
is there
Tasha.
anything closer to then? That's 3 off to 247s.
Yep.
All right. So we won't split it in half. We'll give 2 gift cards to were they the closest? Is that right?
Yeah, I think
That
so.
looks like,
We'll
yeah.
give 2 gift cards. Can you share with who those individuals are, and then we'll make sure that we'll get that.
Great.
That's Tasha Park,
Pastor, raise your hand. Okay.
Oh, okay.
and then
And then just so that we make sure for who was the other one?
Tamiko.
See who's on.
Tomiko. I don't know I'm sorry, I don't know. So
If-
Tomiko,
If you could, Tomiko or Komiko, are you saying?
Tomiko.
If you can send your email address and put
Yes.
it in there, then Brother Kwame will get that to us, and then we'll make sure that you receive.
Oh,
Yeah,
Tamiko.
Tomiko. Yes, thank you.
Okay, you received it. Great
Yeah,
job.
I got
Thank you to each of you. We also celebrate the CRA bankers who have helped us with this. And then again, like I said, we'll follow up tomorrow at noon to 1 out of respect to your time. And thank you, thank you, thank you.
Great.
Thank you.